So a fixed interest annuity, again, currently, they're paying around 5% guaranteed. Now, this is what's called a yield, and this is really important to keep in mind because we're going to talk about income riders in a minute and how people have been duped into not understanding the difference between an income rider payout rate versus a yield. So a yield, just like a CD, pays a yield. A fixed interest annuity is issued by an insurance company. It pays a yield. So let's use an example. Let's say you have $100,000, all right, sitting at the bank, a 401k, whatever, anything can go into these annuities. And you're like, man, I'm tired of taking risk, tired of the roller coaster ride of the stock market. I just want my principal protected. I would like some income, but I do not wish to encroach on the principal. I want that principal locked and loaded and guaranteed. So we might do this for 5 years. So the guaranteed rate is 5% for 5 years. Pretty darn good. No fees on this. Agents like myself who sell these get a one-time upfront commission. So we're one and done. This product here pays about 2.5% commission. So we're going to get about $2,500. That's it. There are no more fees. We're going to service the contract, but that's it. That's all we get paid. And the insurance company is the one that pays our commission. You don't. And we'll talk about surrender charges if we have time. But we're assuming you keep this product for the full 5 years. And in this example, obviously, we're going to send you $5,000 a year in interest. And yes, you can take it monthly. And that is guaranteed. So this is pretty nice. You know, sometimes I have people retired. They just want a little extra income. Maybe they're figuring out a way to produce some income to make a car payment or whatever, just real simple stuff. But they like this. Or they might say, well, I don't need the interest. Can I just let it compound? Of course you can. And the beauty is at the end of the 5 years, let's say you've taken the interest out over that 5-year period, the 5 years is up. We know for a fact that you're going to have your $100,000. Pretty cool stuff. And again, we offer these products. Be happy to talk to you about them in more detail. So that's a fixed interest. But what is the fixed indexed? Okay. First of all, I'm going to put 0% here, and we're going to talk about the same $100,000. So you say, why do you have 0%? Well, first of all, the fixed indexed annuity, unlike a lot of people will tell you, you'll probably make 5, 6, 7%. It is not guaranteed to pay anything, folks. There are years with a fixed indexed annuity, and you'll see this in a minute, depending on what the stock market's doing, you may not make anything. Now, you cannot lose any money. Remember, anytime you see the word fixed, there's no losses to that principal or whatever you make. So how does a fixed indexed annuity work? It's based on when you took the contract out. So let's just for the heck of it say you're going to take one out here in June 1st, 2025, and then we're going to look at this again in a year. So most of them are based on an annual contract. So all they're going to do, they're going to take your $100,000. The insurance company is going to take that off. They're going to use their normal dividends and whatever they make on it. And they're going to buy options in the stock market. I'm just making this real simple. And if the market between here and here goes up, that's called point to point, from this point to point, by the end of June 1st, they're going to pay a percentage, listen closely, a percentage of whatever the stock market made. So let's say the stock market went up 10% that year. More than likely, you're not going to make 10%, all right? They're going to pay, let's keep this real simple, they're going to pay something called a participation rate. We call it a par rate. And let's say the par rate is 40%. Now, this is where I would say the indexed annuities of today aren't as good as the ones 20 years ago. Par rates used to be in the 70 and 80% range, and I'll show you why this is important. But if the par rate is 40%, and let's say they're using as their index the S&P 500, and that was what you made, right? 10% if you were in the market, but when you're not in the market, you're in an indexed annuity, they're going to pay 40% of 10%, so your rate of return is actually 4%. Okay, and this is why many people are looking at a combination of these. We do usually a combination because somebody might say, well, wait a minute, I only would have made 4, even though the market made 10, but over here I could have made 5 guaranteed without worrying about the market. Why wouldn't I just do this? And some people are doing this right now because these interest rates are so high. But let's say, and I'm going to, Aaron's going to have to follow me over, but let's say the next year, so this will be your new floor. So now that's a nice thing. So $104,000, we go out the next year, 6/1/27, and let's say the market, this point to this point, crashes. This is why people like indexed annuities. You do not lose what you just made. However, here we are again, we're still only at $104,000. because again, you actually technically didn't make any money. You kept your new floor, but since the market crashed, you didn't make anything. But now here's where an indexed annuity is kind of interesting. Picture yourself in the stock market. You'd be way down here waiting for that thing to come back. It could be years before you get back. In fact, we saw this in 2008 when the market crashed. It took over 4 years to get back to break even. But in an indexed annuity case, we got room for one more here, Aaron. Aaron, follow me over here. Now we go out one more year. Now we're way down here, which we get to start here. And let's say it does go up 20%. I mean, that market could go up 20%. You would make 40% of 20. You would make 8%. So you have a new level here. So you had 8% to 104. I'm just ballparking it. That's roughly 113,000. And that's your new floor. So at least you know you never can lose what you made. So these work well over long term. In fact, usually with a fixed indexed annuity, we usually set those up between 7 and 10 years. This is still kind of a long-term play, folks, because over the short term, there could be years you don't make anything. If you need short-term money, if you're looking for an annuity that's more accessible within the next 3 to 5 to 6 years, especially as of the date of this recording with interest rates so high, we might go here because this is a sure thing.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips and be sure to hit that like button and that subscribe button for more videos.